Well, the record run continues on Dalal Street. The markets gained for 7 straight weeks, a first in 3 years. IT and metal stocks led the rally. Over the next 30 minutes, we discuss a lot of things. First, of course, what's the Fed rate cut commentary? What does it mean for the market? We put the spotlight on Nifty IT, which has been the best performing space in the last couple of days. PSU banking stocks and the Nifty Realty Index. Hello and welcome to the Editors Roundtable. I'm Sonia, with me editors Reema, Nimesh, Prashant. Folks, what a week it's been for the market, right? No complaints at all if you were a bull, and pretty much the Santa Claus rally playing out.
You know, I always complain that we use, all of us, we use the word seminal too loosely, right? I mean, seminal this, seminal that. But I think the last 2 weeks, I think we can use that word with some amount of clarity. It has been seminal. You know, last week was all about the local politics. We came in and, I mean, same time we were sitting here last Friday and we were talking about how the Nifty is up 3.5%. Now we are sitting this week, this Friday, and the market is up another 2%. Yeah. So in 2 weeks flat, I mean, it's been 5.5%, almost 6% gains on the Nifty. The Bank Nifty is up 7.5%. So it's just been incredible.
Okay. You know, Nimesh has a big smile on his face.
I'm smiling for a reason, Sonia. The reason is, I spoke about Ritik stocks doing good, and I look at the kind of pullback you've seen in all the large cap names, ITC, TCS, Infosys. HDFC Bank has also pulled up. So in a way, I'm happy that that piece worked very well. It was very timely. But I'll tell you, while we are talking about Nifty up another 2.5%, Bank Nifty doing good. If you asked retail traders and investors this week, none of them are happy because the portfolio has not done well this week. The mid cap index and small cap have relatively outperformed, but not great addition to their portfolios. But you know, IT is up 7% in 2 days. The index is up 7%. But if you ask on the street how many people are owning IT stocks, not even the fund manager were owning IT stocks. So on the index level, it's looking good. The screen is looking, like wow. But if you ask the retail traders and investors, they are not very happy this week. Because their portfolio is not done well.
Last week, mid caps did very well. Today's just this week, the large caps took over.
Absolutely. And, I think the line this week that stayed with me is from the conversation we had with Nilesh Shah, where he said, God is an Indian, right?
Yes.
I mean, that really stayed with me, that everyone and anyone is bullish on India. So maybe God is an Indian, you never know. But okay, I just want to put some things into perspective in case you missed out on the week, right? After the big surge that we've seen this week, how do you approach the markets? So the Nifty is up about 2% this week. The mid-cap index is up 2.6%. I'm watching out for a couple of big trends. One of them is the tech sector. And of course, Reema will talk more about that. But it seems to be like a Goldilocks scenario for the tech sector now. On one hand, the US Fed has said that they're looking at 3 rate cuts in 2024. On the other hand, they've talked about a very, very low probability, in fact, no chance of a recession coming through. And there's also the US 10-year yield that slipped below the 4% mark in the week gone by. So this is pretty much a Goldilocks scenario for the tech sector. So that's one thing to keep in mind next week. Large caps could continue to outperform. Remember, this was a week that belonged to large caps. ICICI Bank, SBI, DLF, IndusInd Bank, all sitting at fresh 52-week highs. Maybe that's something that can continue. And rate sensitives continue to be in focus. Actually, that's the big theme of 2024, rate cuts. After what the US Fed said, all eyes will be on the RBI and when they come through with the rate cuts, and that's something that the street is focusing on. Real estate, NBFCs, autos are in focus. In fact, I know Nimesh will talk more about that, but real estate stocks are still below their all-time high. So just to give you one example, right, DLF is still 70% away from its lifetime high. The lifetime high of DLF was 1,225 way back in 2008, and it's 70% away, so there's still more time to go. But before we, get to individual pieces, let me just welcome Andrew Holland of Avendus Capital as well. Andrew, how are you feeling about this market now? Is there any caution on the horizon, or do you think we're still good to go for more?
I think we're probably good for more in the first quarter. Our thinking is probably there's another 5% upside. Between now and the end of the first quarter, being March of next year. I think you've got to think about what the Fed did. I mean, he was so bullish or dovish. It was such a big turnaround. So I can only think that he's seeing something we're not seeing in terms of the economy slowing. But he was very adamant that interest rates are going to fall. So, the market's loving this, right? All we have to think about now is when. Our guess is that the first quarter, maybe by March, he'll reduce interest rates. And then then we'll start thinking about when the RBI is going to reduce interest rates. So it all falls into a very nice kind of election run helped enormously now by the Federal Reserve kind of just turning on completely on its head in terms of where it was 2 to 3 weeks ago.
Yeah, all right. Well, the big talking point, absolutely, Andrew, is what the Fed has done, guys. And, last week we were talking about the local elections. This week, I think we have to. That's a dominating driver, right?
Yeah.
What the Fed has done. So let me actually head over to the big wall and tell you, the focus of the piece really is how do markets trade around rate cuts, right? That's essentially what we are looking at here. So 500 basis points of rate cuts over the last 20 months. And now we finally have, after many ifs and buts and whether it'll happen, not happen, soft landing, hard landing, pivot coming, we finally, I think, have a pivot, which is basically a complete U-turn in terms of what the Fed is now saying they would like to do next. So this is essentially, the setup. First 25 basis point cut is now being priced in by the market in May of 2024. The market is saying that the inflation trajectory will be very benign, which basically will allow the Fed to cut early so as to sort of, prevent over-tightening and the resultant effects of over-tightening, which could be a recession. So that's essentially what the market is betting on. Almost like immaculate disinflation, right? Not too hot, not too cold. Will it pan out? We don't know. Now, rate cutting cycles are basically of two kinds. One is because there is a recession. I mean, the economy goes through a recession, so the central bank is expected to step in. These are those recession rate cutting cycles: 70, 74, 80, 81, 89, 2001, and 2007. Of course, this is the global financial crisis we are most familiar with. And of course, there are also some sort of rate cutting cycles where there is no recession. 84, 87, that stock market crash in October of 87, 95, 98, and 2019 as well. But both these are very different in terms of how the markets kind of behave. So what I've done is for our purposes, since the market is saying that it's going to be a soft landing, no recession or anything of that sort, let's just take the no recession rate cutting cycles. I've not used all the examples. I've only gone back all the way till 1987. And this is the quantum of rate cuts that we saw. The first cut happened, these are the dates, August 1st, September 29th, etc. And this is the total quantum of the rate cut that we saw in that particular cycle. Now we come to the more interesting part, which is what happens to the market going into rate cuts and what happens to markets coming out of rate cuts, right? This is, remember, the no recession scenario. And this is the picture which emerges. Broadly, it kind of, the picture is that 3 months before the first rate cut, markets kind of slow down, quieten down a little bit. Actually, there are, three instances. One instance where there's a 20% plus decline. The 1998 was an 8% decline. 2019 was a 1% kind of a move. So, of course, there's the 9.5% move in 95 as well. But broadly, more times than not, markets quieten down a little bit, even correct a little bit, going into the first rate cut. What happens 6 months out after the first rate cut? I think the evidence is pretty much clear. The bias is on the upside. The degree varies. The big one, of course, is the 25% move that we saw in 1998. So interesting. Now, I'll just look at the with recession scenarios, right? Rate cuts with recession. And I'm just using two fairly recent examples. 2007, where the Fed cut by 500 basis points. This is the global financial crisis with Lehman, etc. And 2001, where the Fed cut by 550 basis points. Here, the picture actually completely changes. So I don't want to kind of present the picture of what happens into and out, because these are recessionary periods, and you can see what happens to markets. In these two instances in 2001, 2007, S&P peaked to low. The fall almost 40 and 60% respectively, and earnings per share for the index fell 23 and 45% as well. I'd like to say once again that the base case is that we will actually not see a recession. At least market is not pricing it in at all. It's not in the market's forecast that there will be a recession. They're very focused on the fact that it'll be absolutely perfect kind of soft landing along with rate cuts. It's never happened. Many have pointed out it's never happened in history. You do get a little bit of a bumpy road, and the degree varies, but you do get that. Will this time be different? I think that is the question we need to kind of answer. We'll know only and be wiser in hindsight. Andrew is with us. Andrew, I don't know if you have any thoughts on this one, because you know, if market pricing is to be believed, the first cut is not that far away. Is, I mean, what, you know, 4 months out from where we are right now.
Yeah, Prashant, as always, your stats are fantastic. And I think we talked, you know, some time back when I said, you know, that crash of 87, everyone was expecting a recession. It didn't happen, but it happened 2 years later. And I think, you know, to my mind, the, you know, the COVID situation, the money that was thrown into the market probably has delayed this kind of real downturn. But if I look at the kind of nominal GDP growth that he's talking about, yeah, and taking into account inflation, it's really talking about real GDP growth of just over 1%. So there's not a lot of margin of error there for him to you know, to play around with. So I honestly don't remember a soft landing in the years I've been in the markets, and I'd be very surprised if we get a soft landing this time around. I think where he will probably be more proactive, Prashant, is that if you remember, we all kind of were talking about how slow the Fed were when the inflation was ticking up, and how he felt it was transitory, and he was too late. He's hiked too high. So this time around, I think he's going to try and be on his front foot and get interest rates lower a lot quicker than the market's kind of anticipating. Now, in my view, I think, you know, he's talking about 75 basis points. I reckon it's going to be nearer to, you know, over the next 1.5 years, at least 300 basis points you're going to see of reductions in interest rates.
Got that. Let me just take this forward. The big beneficiary of the Fed pivot this week were the IT names. So Monday, Tuesday, Wednesday, the IT stocks did absolutely nothing. But on Thursday and Friday, the Nifty IT index rallied close to about 8.5%. And from the lows on Wednesday, the IT index is closed up with a near 10% rally. In fact, in these 2 days, on Thursday and Friday, the IT stocks added about 2.5 lakh crore in market capitalization. So some of the reasons are that, one, it's a catch-up trade. The Nifty IT index, even after this recent rally, is still about 10% away from its record levels. Two, valuations are not back to their post-COVID digital transformation boom levels, much lower than, you know, by 15-20%. And third, the Powell speak has given some confidence that maybe the clients will be more confident, the U.S. clients, about the U.S. economy. Maybe they will be willing to spend more. Decision-making cycles, which were getting elongated, will now start getting compressed. So that's the hope which is built into the market. But along with the hope lies the risk. The risk is that, at least as of now, there is no immediate pickup in the demand. Q3 is going to be a weak quarter. Most companies have guided for higher than normal furloughs. Clients, as of now, you know, when we chat with the companies, they're saying the clients haven't committed to any pickup as of now. So we'll have to see how things play out in Q4. So that's the risk associated with it. But IT has had a field day on Thursday and Friday. Andrew, is this up move that we saw in IT names just a tactical recovery, or do you think, you know, fundamentally, structurally, some things may have changed with the Fed pivot?
Structurally, nothing's changed. I mean, the results of the IT companies will continue to be poor for the next 2 quarters. There's absolutely no way that's going to change. The Fed's U-turn is going to change that situation. But what it has done, and we talked about this before as well, is that once you felt interest rates are going to come down in the US, that would obviously have the tech sector, you know, moving higher. That's a tailwind for our IT sector. And it's usually there's a lag in terms of, you know, how that benefits IT stocks. So it's a trade. And you know, there's nothing changed fundamentally for the IT stocks. And if there's no soft landing and it's more of a harder landing, then a lot of these gains that you've seen in the US for the tech stocks will reverse, because earnings will have to be revised downwards. So it's great for the interest rates. Interest rates are going to be the focus of attention for the first quarter. So IT should continue to do well, at least on the sentiment-wise of interest rates falling, but not on earnings.
Got it. Let's talk about the real estate index, because along with IT Realty did well. In fact, the index closed at a 14-year high. But Nimesh, none of the stocks are back to their record levels.
Actually, that's the big story. You know, while the index has hit a fresh 14-year high this week, this month the reality index is up 7%, but none of the individual stocks have hit the previous highs. But let me just go to the wall and explain what's worked for the real estate sector and whether this can continue. So the big point is this week, the Nifty Realty Index has hit a fresh 14-year high. So it's a kind of a technical breakout, so to speak, for the real estate index. But what has worked for the realty sector? A couple of reasons why the real estate sector is doing well of late. The first is the industry consolidation. After 10 years, you've seen a massive consolidation in the real estate industry. The second big reason is the regulatory framework, including the RERA. RERA has been a big talking point for the real estate sector, and they've done well because of that. So, and the third is the disciplined approach from all the developers. Now, the companies are focusing on free cash flows, working capital cycles, and execution as well. So that's been the key reason why the reality index has done well so far. But what can be the trigger going forward? The big trigger for next year, which is in FY24, could be the rate cycle. If you see an interest rate cycle coming down, you can potentially see a further stimulus for the real estate stocks and the real estate sector to do well. But as I said, while the index has hit a fresh high, not a single stock in the real estate basket has crossed their previous highs. Let me just go to the table and explain what I'm saying this. DLF, for instance, the stock is up 76% this year. In 3 years, the stock is almost doubled, but still from an all-time high, the stock is down 45%. Same is the case with Godrej Properties as well, up 55% Y2D. In 3 years, it's given 45%, but still away 26% from their all-time highs. Similar is the case with Prestige Estates as well. The stock is already 137% this year, almost up 3 times in the last 3 years, but still away almost 50-60%. DB Realty is another example to track. This stock has been on of course, it was a penny stock, but this year the stock is 110%. The stock is almost gone up 1,200% in the last 3 years, but still the stock is up 63% away from its all-time high. So these are the few large cap stocks that I've identified. Even if you look at the mid-cap sector, mid-cap stocks within the real estate, the story is the same. Look at Anantaraj. That stock is up 150% this year. It's almost up 3 times in the last 3 years, but still it's away 28% from its all-time high. Shobha is the same example. Even Mahindra Life is up for almost 3 times in the last 3 years. It's up 374%, but still it's 10% away from their all-time high. Same is the case with Sunteck Realty as well. I just want to focus on one stock, which is in this mid-cap basket, Indiabulls Real Estate. It's been pretty much flat. 1 year or 3 years, it's been pretty much flat, but still the stock is still away 89% from its all-time high. And the other example I want to highlight is Unitech. Unitech is on a tear. Of course, it's a very penny stock now, but that's up 417% this year itself. It's and again, the Unitech stock still is away 98% from its all-time high. So that's the clear picture that while index has been at a record high, none of the stocks have been. So I've also looked at the fundamental and technical reasons. So the fundamental reason for the real estate sector. I've picked up a report from Morgan Stanley. They reported on December 10th. They believe that the demand support is quite strong, and that's been a positive for industry structure for which they are very bullish on, and they expect the multi-year cycle to continue for the real estate sector. What are they betting on in the real estate? They prefer companies which has got a strong pre-sales growth as well as strong growth without adding any further debt. So that's been a key trigger for a lot of real estate companies. I've also looked at the technical feedback from Rahul Sharma of JM Financial. He believes that the reality index can double in the next 2 years from now. So they have a target of 1,500 on the reality index. Currently, it's around 770. So what is he betting on in the real estate names? He believes that while the large cap stocks led by DLF has done well this year, it could be a catch-up time for the mid-cap and small-cap real estate stocks to do well. So he's identified 3 stocks in the real estate basket which he's betting on for the next few years. The first name is Indiabulls Real Estate. It's been a big underperformer. He's betting on that. The second is Keynote Realty. Of course, Rustomjee is the brand name for them. And the third name is DB Realty. So as I said, while the index has hit a 14-year high, is on a verge of a breakout, but none of the individual stocks in the real estate basket has still crossed its previous highs.
Okay, Nimesh, thanks a lot for that. In fact, that's an interesting question that we want to pose to Andrew as well.
Sonia, and I put this question, if you remember, to Prestige in the morning. We had the Prestige management. You mentioned, Nimesh, all the fundamental and technical reasons. I suspect one big reason, which there is no way to kind of quantify this or put numbers to it, I think is a stock market boom as well, right?
Of course.
There is equities have done so well, and the wealth effect is so powerful.
It gets into real estate as well.
Yeah.
And look at what has happened in the last 3 years. Yeah. Even in the real estate sector, the top end real estate has done well. Yeah. The 10 crore plus homes have been sold more than the lower end. So that's the wealth effect which you're seeing getting spilled over to the real estate from the equity market. So, and again, the rate cycle, we were all talking about rate cycle, that's a big sensitive sector, the real estate sector, which can have a big impact on the real estate stocks and the sector overall.
Although on rates, I mean, I sometimes wonder, on the way up, when rates were going up, sales didn't get hurt.
Yeah.
So when rates fall,
No, it just.
I don't think somebody who can afford a 10 crore home, I don't think interest rates really matter to them,
it's not about-
to be
maybe on the
honest.
affordable side. but-
On the affordable housing
impact.
segment, yeah, of
But
course.
you know,
of
the
course.
other big thing, wealth effect, is also the ESOPs, which, the startup guys have got, right? That's
Yeah.
also been channeled into
the
real
real
estate.
estate.
But here's what we'll do. We'll slip into a very short break. We'll come back and talk about PSU banks and this mad rush that we've seen as they launch their QIPs this week.